areas around significant downside from here as a result of breaking that level in the SP 500. In the meantime, you've got Euro markets which have drifted back into negative territory after initially seeing somewhat of a recovery. Keep in mind, of course, it is a triple witching day today, so this could be causing some volatility in the markets, apart from the fact that the market's still digesting what it means for a tapering off of quantitative easing towards the end of 2013. And of course, September is the time when most are saying that is going to start. So we have, of course, seen the markets being bruised and battered as a result of this. And then the question from here on out is for how long this is going to last. But certainly when you're looking at the emerging market space today, emerging markets have been hit by what's taken place as a result of the Fed announcement and investors pulling out of developing countries. You've got the Sensex, which managed to escape the downward trend in emerging markets, up by 0.25%. The Hang Seng over in Hong Kong was up by 0.6%. Brazilian market down once again today, shedding 2%, and the Russian market also softer there by 0.5%. Overall, the MSCI Emerging Market Index down this week 5%. Looking at how commodities are faring this hour, you've got a rebound in copper, up $36.50, $6,775 a ton. Of course, is still weighing on the markets when it comes to the commodities picture is that weak PMI figure, which also came out this week, showing that the flash PMI figure from HSBC for June sitting in a 9-month low. Brent crude continues to trend low, back towards $100 a barrel is what we're seeing right now, down by 1.5%. Looking at how that gold price is faring, you're looking at a rebound on the gold price, up by 0.75%. Of course, gold has been hard hit by the Fed's comments, but still below $1,300. Platinum on the back foot, slightly there, ever so slightly, $1.20. Just looking at some other news flow on the day, if you're looking at overall how markets are trending, some stocks to look out for. Facebook in the tech space being upgraded to a buy by UBS. We'll be looking at Facebook's outlook in light of how it's positioned in the market shortly. Alexandre Nossovskoi joining us from Canada, and he, of course, is an analyst at Saxo Capital Markets. Thanks for joining us today, Alexandre.
Thank you very much.
Let's firstly get your perspective on the Fed announcement this week and what a tapering off of quantitative easing means for the markets. How should you be positioned right now?
So honestly, looking at QE, we know that the purpose is to increase liquidity in the market. So when the Fed offers money into the economy, it does this by printing money and then purchasing bonds. At the moment, in banks, they're holding on to a lot of mortgage-backed securities, which are troubled. So what the Fed does, it buys out a lot of those mortgages and pumps money into the banks. Banks do with this money, what they're supposed to do is to lend it out to investors, to small businesses, anybody who wants to grow. And that's supposed to help the economy. However, because at the current risk profile, it doesn't make much sense to lend to small businesses and investors. So that money goes straight into the economy. And it won't be into bonds because bond yields are low. It'll go straight into equities. So you end up with a sort of inflated market, if you know what I mean. It kind of, the prices are held up. So really the question is the economy doing poorly because there's a lack of liquidity? If so, QE helps a lot. If that's not the case, then when they pull back the gas on QE, the economy will drop a bit in proportional to the amount of QE that they take out.
But where are stocks trading in relation to a possible pullback in the economy? And I suppose it's hard to gauge what that would mean.
Well, in this case, markets trade on expectations. So most investors didn't think QE would start a pullback as early as September. Only 20 investors up to early June survey. But now that the Fed made the announcement, investors are now listening to the Fed and they're thinking, the Fed thinks that the economy is going to get stronger. That means that we can start putting our money back into the United States. So even though QE reduction hasn't started yet, people are already pulling money out of emerging markets and back into the American dollar, which in effect, it may be good, but it also might be dangerous because if the fundamentals of the economy don't match up, a reduction of QE will actually bring the economy down and will leave a lot of investors disappointed.
And of course, this is why perhaps the Fed will be testing it with a gradual pullback and a tapering off. Your view right now on commodity-linked countries like South Africa and, of course, Canada being in the same boat there, even though we've got a developing versus a developed world economy, certainly?
Absolutely. Looking at that, because of the massive pullback from emerging markets, you end up having a big issue with falling, and on top of that, you have falling commodities. And when you have falling commodities, let's say gold, for example, South African mining companies that collect gold won't necessarily be able to sustain that because it becomes a break-even proposition. When gold is cheap enough, they can't sell it to make a profit. So what I think is going to happen, and particularly in gold, is that the market itself is going to drop just a tiny bit as production is reduced. But as supply is limited, gold's going to go on a small uptick, and then it's going to flatten out.
Okay, flatten out to where? Because we need to get onto the tech sector. That's what you look at.
Certainly. So the important thing about manufacturing. So China is a big, important player here. We know that Chinese manufacturing has been prevalent, and they used to compete with the United States in the following way. The United States would innovate quickly, produce the latest gadget or sprocket or whatever it is they make, and China would copy it, mass produce it, and make it cheap. But because the Chinese currency is now becoming stronger and stronger, and they can no longer control them, and they can't sustain their infrastructure growth, they start to switch to a consumer-based economy like the United States. So how does the United States compete with that? Because China's now going to eat its lunch. It's focusing on Silicon Valley, new technologies, web, that kind of stuff. And I have a couple of views on the different markets. Which one?
Let's start with Facebook, as I mentioned, because of course UBS came out today. That stock could be in focus with the upgrade there to buy. Do you stand in that camp that is quite bullish?
With Facebook, actually, I'm a little unsure about Facebook. I'm a little more neutral. I would hold off for now because Facebook either will succeed substantially or they will fail like MySpace did. And the reason I say this is because consumers are fickle. And so when it comes to something like Facebook, if it loses their attention, they'll go on to do something else. And here we're kind of worried that we know that a lot of the younger generation, even younger than me, are heading out to other platforms, and they're thinking, oh, Facebook isn't cool anymore because my parents are on it. And a lot of people talk about...
So what's the new cool social media from a stock perspective?
Well, unfortunately, there isn't a big one yet. It's kind of up in the air. I think investors can be quite savvy and look at it. But a lot of people are talking about the Facebook versus Twitter comparison, and Facebook just came out with Instagram for video, which is competing with Vine, which is a Twitter product. And honestly, I think they don't compete. People think they're both social media products that compete, but they don't, because Twitter is unique in the market. You can know exactly what's going on all around you by doing a quick search on Twitter. You can't do the same thing on Facebook. So I think Twitter is a probably definite buy, at least for now. But Facebook, I would wait and see a bit until it clears up. Okay,
let's talk about cell phones, smartphones, and the race on that front. And I suppose it goes far beyond just smartphones if you're talking about Apple and Samsung. But one of the stories which came out today from Tokyo is that Samsung has been said to have infringed on patents held by Apple. We know this is a story that rolls out in so many countries. It started with the US court. But of the two stocks right now, do you have a preference?
Apple, for sure. First of all, the patent war will always go on. Software patents are a complete mess. So there's always going to be litigation, so I'm not as worried about that. But I definitely think Apple, because they have a lot of money in reserve. They have 85 billion or something insane. So I think the stock is a little undervalued. You get the stock, and something has to happen.
At what level?
Well, at the current level, it's actually a little undervalued. But they have all this money, and what that money is going to do is either become a dividend, either they're going to make massive investments into either new industries and grow, or, well, I guess we'll see. But this money is really important because it lets Apple lock down huge contracts for immense amounts of components for their technology, and they stay ahead of the curve like that.
And what about the kind of older tech companies? But certainly stalwart, Sony, Microsoft, do they still have a place?
Sony isn't doing too well right now. In fact, a lot of its divisions are actually failing. They're not making any money. And they want to stay competitive with their new Sony PlayStation 4. Microsoft is doing the same with its Xbox. They just want to capture the set-top market. They want to be the next television. The problem is that not as many people are buying televisions, and set-top boxes aren't doing too well either. So for now, I would stay away from Microsoft and Sony, definitely Sony, Microsoft to a lesser extent, and wait a little bit to see if people start buying these consoles. If yes, then maybe it's an okay indicator to start purchasing into those systems.
And of course, when it comes to the tech space, there's so many startups, there are a lot of stocks that we might not be aware of, but certainly you would be aware of. Any stock tips or any ones to watch out for? That could be the next Facebook, the next Apple, the next Samsung?
I've been looking at the technology sector, and there's a lot of really exciting stuff happening in Silicon Valley. And one of the interesting products that I saw, it actually started on Kickstarter, is